Well, today we've got a lot to talk about. The stock market is exploding, my account's exploding. What a couple of days it's been in my portfolio. And 2023 was a good year in the markets, but 2024, what another year it has been. And it's really good to see that rewards come in. And today we're going to have a little bit of a reflection on that. And as well, we're going to talk about the interest rate cuts because we've got US and UK talk. Well, we have had interest cuts in the UK, and we're going to talk about what that means potentially for stocks as well. So hope you enjoyed the video. Hit the like button. Let's get started. So what a couple of days it has been in the markets. A lot of stocks, a lot of my stocks are doing very well. And yesterday it was topped off by Meta. One of my top 5 holdings. What a day this is going to have. It is up 7% in pre-market. I think I'm up over 140, 150% in one count, and then 200 and something percent in another count. It's great. You know, when I look at my top 5 holdings and how well they're all doing, and now Meta adds to the list, it's really good. We're going to talk about the number 1 guy in a little bit later on in this video, but it's just so good to see once again another stock giving those rewards into the portfolio. But before we do get onto that, I just really wanted to quickly, I told myself I wasn't going to do it, but I felt like I just had to put a little bit of clarity on yesterday's video. So I did do a video yesterday which was talking about why the stock market is crashing. It was not really talking about the stock market crashing though, it was a bit more of a response video. And it did make me laugh because you can actually see who actually watches the video and who just clicks on the title, comments, and then goes off. And it's why I have to like make sure I repeat things multiple times so people can make sure they understand what I'm saying, because otherwise you get comments like this from people that don't even listen or concentrate on what you're saying, and that's sometimes why you have to repeat things. But I had a comment like this from Rob, which sometimes sums up the YouTube audience, and sometimes I think the YouTube audience is very quick to forget things. Sometimes I think they hit the head, fall into a fish tank and turn into goldfishes, because sometimes I can't believe some of the things that I see commented, and either I don't know if there's just lack of knowledge in this space or that people just forget things. And I saw this about a response to the video that I put yesterday saying that I thought a certain YouTuber was basically blagging the market and making it sound like he knows what he's talking about and he doesn't really know what he's talking about. And then I got a lot of criticism. I mean, I get a lot of criticism all the time. Since 2022, I have basically nearly every video I get some stick on a YouTube video, which is, I guess, part of the game. And I've kind of come to understand that is that I'll just get hate on whatever video I'm posting about. Even when something goes really well, I'll get some negative views on here. And you know, normally I kind of take it on the chin, but every so often I like to just dish it back out now, because I think, you know what, why should I take this? You know, I'm the one that's kind of stuck around here in 2022. And I thought, hold on, I'm getting stick from giving someone else a bit of a hard time, but the same guy that gave everyone else a hard time isn't innocent here. Like, are we forgetting about this person made multiple videos attacking the likes of Meet Kevin, Graham Stephan, Andre Jenk multiple times? Same again talking about Tom Nash. Another video talking about Chicken Genius, and even made videos about me in the early days. He made our videos attacking, I think that one that has actually been deleted, but what a surprise, deleting videos. But made a video attacking YouTubers for not showing their actual portfolio, and this is coming from a guy that has never shown his actual stock market portfolio. So yeah, we have someone that's going out and criticising other people and even criticising me and saying they're not doing something when they're not even doing it. But yet I'm in the wrong when I kind of call it out. I don't know, people are a little bit silly on the YouTube scene. I've realised that anyway. But getting on to today's video, I don't want to waste any more time on that. I just wanted to put a bit more clarity on there. Meta, obviously really good day from Meta. The stock is up, and what incredible earnings from Meta last night. The EPS, what a mega beat, 0.40 beat. Revenue, 22% year over year growth. That's very impressive. And beat by, you know, it's not even a small amount here, 760 million. And you know, you can talk about this company like this is, Meta was the one that I was, out of all the Magnificent Seven, good comment on that as well the other day. Out of the Mag 7, you know, this is the one that I was a bit more confident on, because you look at the valuation that Meta's at and it's actually not that bad. And then you look at the profitability they're doing, you look at the revenue growth, like 22% is impressive growth, guys. But yet you look at the valuation, it's 23-4 times earnings. Like, this is kind of understandable, the valuation they're at, and yet the growth they're putting in. Like, this is, if anything, I would argue that out of all the Mag 7, that Meta is potentially the one that you could actually look at and go, it's probably actually still undervalued here. And that's actually why I've never actually sold a share yet of Meta, even though I'm up like whatever it was, you know, 100 and something percent, and in the other account like 200 and something percent. I've not actually sold a share of Meta yet, because I actually look at it and I go, I could argue the case that Meta's undervalued at 23 times earnings, or forward earnings should I say, at the moment. And You know what also was very good about Meta, and I'll actually, when I get on the Patreon a little bit on the weekend and do a full earnings review, I'll do a deeper dive into some of these numbers here. But what a lot of other people and what a lot of other YouTubers won't show you is that actually, what was more impressive is that what Meta did previously to get the growth and the numbers very impressive is they just showed a ton more ads. So ad impressions is how much they show ads on the platform, whether that be more ads on the platform or ramping up reels as well is another thing that they've actually done. But that was up 10% year over year. So they have increased the amount of ads that they're showing to people, but it was up 10% year over year. And if you look at the average price per ad increased 10% year over year. So yeah, they're showing more ads to people, but what they're having at the moment is they're having a rebound on the actual paid price per ad. Now, I don't know if this is because they're just charging more, maybe that they are monetizing reels a lot better, maybe advertising is just rebounding. I hope advertising is rebounding. That's what I'm hoping for. I'm going to hopefully get into the conference call and hear more clarity on what is actually going on there. But this was even more impressive than the last quarter's earnings, because when we got to Q1's earnings 3 months ago, if you look at exactly the same numbers, ad impressions were up 20% year over year, but the average price per ad increased by 6% a year. So they were showing a lot more ads, and people were, they're paying more for it, but not as much as what they were doing. So last quarter, a lot of the growth that they had was just coming from that they're showing more ads. Whereas the one they've just done is not just that they're showing more ads, but people are willing to pay more for them as well, which is a good sign. This is a really good sign that that's happening. Now, I don't know if that's because advertising platforms are coming back and spending more, or Meta are just charging more, or they've just monetized reels a lot better. That's what I'm going to dig in on the earnings call when I do get onto the earnings review on the Patreon a little bit later on. But it looked a lot more positive as well, which was the really good thing as well. I've got to say, just before I move on to the next subject, an increase of 7% year over year of family active people. Like, you think that Facebook can't get any more members, and it just keeps going up and up. I mean, how long to the full world's population is on Facebook or Meta or something? It's impressive, isn't it? But overall, it just made me think about what kind of a cracking year it's been. You look at a lot of my holdings now, especially the top 5 holdings. Hims and Hers. What a year this has been up, 120%. And, Meta, I remember posting videos about $80 2 years ago on Meta, and nobody wanted to own Meta, 2 years ago. People were saying it's a dead company. That's it. It's game over. And, the stock has gone on to rally. I remember people saying that Hims and Hers is uninvestable 2 years ago. And obviously from that time frame, I remember buying at $6 and I was like, this is cheap. And then it went down to $3. I remember being down 50% on my Hims and Hers position, and I was averaging down at $3. I was like, I just can't believe this. And I was getting so much stick for it, like, oh, Hims and Hers is a trash stock. And then obviously the shares that I got at $3 are up 432%, and my main position is up 240% or something like that now. And it just made me laugh when last night I was thinking about this a little bit, and I was thinking about Google. Amount of times I said I'd really like Google to be my largest position. It just never stayed at $100 long enough, and from $100 the stock is up massive since that time frame. Card Factory, I remember even a month ago people were saying, like, why buy Card Factory? I was like, just look at the numbers, guys. Look at the numbers, what's going on, and even that one's woken up in the last month, which has been good to see. Greggs, once again, pushing back up to all-time highs. Supreme, what a year this has been. I remember the amount of people saying, oh, what are you buying, like, vaping stocks for, the regulation around it, and this is up 90%, and I never see any kind of comments around Supreme. If it's something that was down 90%, I still see stocks mentioned that didn't work out, that were sold for big losses, and I still see them mentioned 3 years down the line, still mentioned, and something like Supreme that's been an absolute amazing performer, never get mentioned. And it's just funny how it all works, because at some point, you are going to get some things wrong with investing. If you can get 6 out of 10 right, you're probably going to be a really good investor. If you can get 7 out of 10 out right, you think you're a really good investor. Personally for me, I try to aim for 8 out of 10 if I can get them right. That's what I always try and aim for if I can. But obviously, 2022, really bad year in the market, and so many stocks got absolutely killed in 2022. And I remember, so many stocks being down massively. I still made videos. I saw so many people giving up making content on YouTube, and I stuck through it. I still stuck through it, making all these content about what I'm buying, how I'm pivoting the portfolio, stocks that are struggling during that time frame, and how I'm adapting to the situation. And I remember all the heat that I took, and then all of a sudden, 2023, we bounce back. What a year it's been. 2024, what a year it's been. And it's good because, sometimes, like I said, I don't really talk about it too much, but sometimes there's a lot of hidden pressure on doing YouTube because you get judged massively. And even if you get, 6 out of 10 right, 7 out of 10 right, you'll always see the comments about the 2 out of 10 that you got wrong, 3 out of 10 you got wrong. You'll always see them in the comment section, and you'll always have it, thrown at you. But the pressure to try and deliver a lot of these stocks it's tough sometimes. It can be tough doing some of these investments by yourself, but the fact that you've then got to do a video on YouTube and back them up, and you're going to get judged if they do work out, and if they do work out, you're going to get no credit for it because everyone's going to take the credit and say, oh, it was my idea. And then as soon as something goes wrong, and it's one you talked about, everyone will say, oh no, that one's your fault, why it went wrong. And it's part of the game. It's understandable why it's part of the game, but it's good now that I can actually look back at some of these, the last performance in 2023 and 2024, and say, what a good time it's been, especially for the YouTube channel, about, all these, when you look at the top 5 holdings at the moment, how well a lot of them have performed since they've been on the YouTube channel. And I guess that kind of sets it up for tonight. Can we have the perfect finishing to this week? We have the big one, the king that's going to report earnings. Hopefully that finishes off what has been a good week. I looked at Caesar's numbers. If Caesar's are doing those, that was on Tuesday, doing those numbers, and I think DraftKings has to come in with decent numbers here. How the market reacts, I don't know, but I think that as long as the story stays good, that's the main thing. Blocks reporting, Mercado Libre, once again, on the edge of a top 5 holding. It's very close between that one and Meta. Not Meta, sorry, Google. I think Meta's 4, and then I think Google and Mercado Libre are like tied between 5. Another big one there, and I'm sure they'll report good earnings. So hopefully we get the perfect finish off to what has been a very good week. But just a little bit just to finish off with, obviously we had Jerome Powell, and he said that potentially the door's open for a September rate cut if the inflation data does come in. I mean, even if whatever the inflation data is, I mean, just look at true inflation now, guys. The Fed are using all this backward data that is not very relevant, that has big weighting to out-of-date sectors, and you start looking at true inflation now, guys. I mean, we've been at 2% for a long time, realistically, and you look at true inflation now, it's actually fallen down to like the 1%, and that's probably because the economy is slowing down. You look at the likes of McDonald's earnings and Starbucks earnings, like the economy is slowing down, which is probably good to put pressure on the Fed to cut their interest rates. But it's the fact that we're seeing the typical thing where the Fed only start cutting interest rates when it's getting a bit too late. Now, there's probably still time for them to kind of save this situation, but the economy is showing the cracks, and that's why inflation's coming down so much now, is because the companies are starting to get affected, and we're seeing the typical thing where the Fed move too slow to cut the interest rates, and they end up cutting it when the data is too bad, and they go, oh, actually we're in a recession now, we better cut these interest rates. The cracks are there to show, and that's why the inflation is coming down, because the economy is getting weaker, and however longer they leave it is only going to put more pressure on the economy. So yeah, I think they should have cut by now, and I think they should be cutting in September. The longer this doesn't happen, the more I get worried about the economy in the US. But total opposite on the UK, because we finally got the interest rate on the UK, and that was cut. Same again, I think this should have happened 2 or 3 months ago, but it's good that it's finally happened. It's impressive that we've actually done it before the US. I think that was one of the predictions at the start of the year, that the UK will cut before the US, which not many people were thinking about only a couple of months ago, but the data's been there, and it's good that they've not waited for the US to kind of go, are you going to do it? Because our data is a lot stronger than the US is on the inflation side. Maybe the reason why is because our economy has been even weaker, and that's slowed the inflation down. But yeah, I think this is very much needed to happen. What surprised me is that it was so close. I don't know if you've seen it, but basically 5 people voted in favour for a cut and 5 voted for no cut. And I'm so surprised that 4 people were sat there going, yeah, we're not cutting interest rates, because I don't know what data they're looking at. I don't know what data they're looking at, because they've got inflation at the 2% target, and they have done for like the last 3 months. They've seen the economy slowing down out there at the moment, and just for general people, all these people that have, people will say, well, you should have planned better with your house mortgages. But realistically, did we really expect Russia to go into Ukraine and cause energy bills to go sky high? Did we expect interest rates to go from the lowest they have historically been up to and rise up the fastest they ever have done, up to 5%. The average person doesn't plan for that. Now, you could argue the case that maybe they should have done, but realistically they don't. And it's understandable maybe going up to 3%, 4%, but how fast did it up to 5%? Like, you've just got to have a bit of thinking here for the average person that's out there on the street. And there's all this pressure about all these people getting caught into these higher interest rates. The mortgages are going up by 600, 700, 800, £1,000 a month. Like, you've got to have a little bit of consideration as well for the average person out there as well as the data obviously strong, being strong for the interest rate cuts, because inflation is lower down. So what does it mean for the stock market? Well, this is to do with the S&P 500 and more of the US base than the UK base, so just bear that in mind. But an actual cut can mean different outcomes. If you look at the historic data, it is a bit of a 50-50 split. Well, it's actually slightly more bullish than bearish, that the stock market does really well, but quite often cuts can happen when we hit a slowing economy or we hit a recession. So at the moment, if we don't really hit a recession, it could be quite bullish for the stock market. But these are the historical returns, as you can see here, and it's a wide bunch. There's not really a big definition of what will potentially happen with an interest rate cut, because a lot of them have depended on certain variations of what's going on in the economy out there. Looking at the moment, obviously, you look at when last time we had an interest rate cut, 2019, the economy was still okay, did okay. That 2007 was obviously, the Great Recession. 2001, obviously, you had the tech bubble. So when it's major events and major recessions, normally it has led to the stock market not doing that well. But when it's not been that major events out there, the stock market is normally done quite well off an interest rate cut. So maybe it's quite bullish. I would say to the side of that it's probably more bullish, but there's definitely no definition of how the actual stock market will perform. Now it has got the interest rate cuts here, but what I think it will mean more than anything is the S&P 500. The other thing about the S&P 500 is also, we are at historic valuations, which is something that also is another point that you could factor in here. The S&P is, in my opinion, overvalued. But what I will say, in what I have said for the last kind of 12, 18 months, and I think a lot of you guys as well, is that a lot of us have been looking at the small caps. A lot of us has seen the small caps as the opportunities, and that's certainly what I've been buying, and some of you guys might be buying. And since I bought the S&P, I never buy an index, but I did buy the index S&P 600, as some of you guys know. And I think about that at the back end of 2023. I'm up about 20% on my S&P 600 ETF that I do have. But if anything, what I would expect is these interest rate cuts to be good for the small caps. The S&P 600, the Russell 2000, these have, in this higher interest rate environment, this has done nothing for 2-3 years. It stayed flat. It's not done anything in the market. A lot of smaller market caps are more sensitive to interest rate cuts, or higher interest rates or lower interest rates, because they need cash a lot more. They need a lot more cash than the big boys, than the S&P 500. And the fact if they're able to get cash at lower rates, it's good for the small caps. That's why they perform better in lower interest rate environments, and why they don't perform as well in higher interest rate environments. It's seen as that if they're having to access cash, they get it at the cheaper rates. And also another factor that is probably worth pointing in, and this actually goes a bit more to the UK side, is that if the interest rates are starting to come down, a lot of people have been sitting in cash. They've been sitting in cash going, I'm getting this, 5% cash, 5% interest on my cash. Well, if the interest rates start coming down, and the interest do start coming down to 4.75, 4.5, 4.25, 4%, having the cash in these high interest rate accounts suddenly starts getting less attractive. And what gets more attractive is that, I can go get a company like Money Supermarket, for example, which I'm going to just quickly do. I ain't got this one up. Oh, they're not called Money Supermarket anymore, are they? They're called Money Group. You look at Money Group, for example, and their dividend yield is 5.13%. So as the stands at the moment, why go buy Money Group when I get a 5% yield and I'm getting 5% interest on my cash with no risk? All of a sudden, if that interest rate starts going down to 4.5, 4.25, 4%, and you're like, hold on, is it worth taking me that risk now for that extra 1%, 1.5%, 2%? So when that does start coming in a little bit more of a factor, then do we see the cash rolling into some more of these dividend stocks as well, which is also the other counter argument that you could have here as well about how some of these stocks do perform. We've seen a lot of stocks like Legal & General, for example. I mean, how long has Legal & General been sitting on a really high dividend yield? It's currently sitting at nearly 9%. So how long are people going to sit on cash and go, my cash is now only getting 4%, but I can go get a double that by putting that into legal and general? Do we see the attractiveness in legal and general coming in? And also, obviously the other benefits is that there's many benefits. You look at the like housing stocks. How are these housing stocks going to start reacting now? Because obviously, people are going to be more that being sat on the cash, maybe not buying houses. Go, oh, you can actually get a lot better rate now. And do we start seeing the uptick now from the like Barratt Developments and Red Rose? It's it's probably really good news for us guys anyway. So we'll see what happens. About time it happened. Bit of a long video that. A lot of subjects covered in one video. So I hope you don't mind. And if there's a subject you don't like, I hope you skipped it. Apart from that, thanks for watching, guys. See you in a bit.